Good morning and welcome to the Killik & Co podcast. It has been a fairly quiet week for economic announcements, but it has been the 10-year anniversary of the start of the financial crisis. So we've been looking back over the last 10 years and considering how the banking sector has changed. It's obviously quite difficult to pinpoint the exact moment that the financial crisis started, but generally it's agreed to be the 9th of August 2007. And that is the day that BNP Paribas, the French bank, announced that it was closing 3 funds that invested in American mortgage-backed securities. And the reason it closed those funds was that the liquidity for those securities had completely dried up and it had no idea how to value them. 5 weeks after that, we had Northern Rock going to the Bank of England to ask for support, and it wasn't until a year later that Lehman Brothers filed for bankruptcy. And for many people, that is considered to be the peak of the financial crisis. If you have a look at this chart here, you can see how banking shares have performed over the last 10 years. So the blue line shows the performance of American banking stocks, and the orange line shows the performance of European, including UK banking stocks. It's indexed, so if we consider that 2007 shows 100%, looking at this chart, you can see that 2 years later, by 2009, banking stocks across the world were worth 20% of what they were previously worth. Since then, we have seen some recovery, but banking stocks in both the US and in Europe are still way below where they were previously. US banking stocks have recovered slightly more quickly, and that's because American banks restructured more quickly following the crisis, but nevertheless, there is still quite a long way to go. And thinking about regulations in banking, we are still seeing regulators fining banks for things that happened during the financial crisis. And over the last 10 years, the US regulator has collected $150 billion in fines from banks. And that figure globally is $321 billion. And that equates to $43 for every single person in the world. So we're still saying that there is quite a long way to go in terms of sorting out the regulation that's left over from the financial crisis. There have been a number of changes to banking regulation in the last 10 years, and I think it's fair to say that banks are now in a much safer position than they were before. And this slide here just shows some areas that the regulator has focused on. So first of all, banks now have to go through regular stress tests, so they have to model their own activities and demonstrate that they would be able to cope in particular economic scenarios. They've also been banned from proprietary trading, which is when they use their own money to trade and to make profits for themselves. There's also a much bigger focus on suitability for clients. So if a bank is doing something for a client, it has to make sure that that is suitable for that particular client. So for example, if a bank is giving someone a mortgage, it has to make sure the person has the capability to pay back that mortgage. There are also rules around core capital for banks, so that means that banks have to have a certain proportion of good quality assets on their balance sheets. And last of all, we do have more of a focus on global regulation. So before the financial crisis, we did have a situation whereby global banks were regulated by national regulators in individual countries, and that didn't really work. So now we do have a number of global regulators that do oversee the global banking system. Now, I've said that banking shares have fallen in price over the last 10 years, and that's definitely true, but that doesn't necessarily mean that banking stocks are cheaper. So let's have a look at how banking stocks are valued. We'd normally look at a measure called price-to-book ratio, and that measures the price of a banking share to the level of assets that the bank has on its balance sheet. So the higher the price-to-book ratio, the more expensive we would consider that particular banking share to be. And this chart here shows you how the price-to-book ratio has changed over the last 10 years. So in 2007, you can see the average ratio for American banks was 1.62, and European banks were more expensive at 1.86. Moving on 10 years, you can see that the price-to-book ratio for American banks has fallen to 1.21, and for Europe, banks are trading below book ratio at 0.96. And the reason that American banks are now trading on a slightly higher multiple to European banks is that Donald Trump is considering lowering banking regulations in the US, which would make banks more profitable. So people do feel slightly more confident about the US banking sector compared to the European banking sector. So that's it for our 10-year review of the banking sector. Moving on to the week ahead in the UK, we do have a bit of nervousness here about the situation between Korea and the US. That has caused a bit of global concern, and we have seen global markets coming down a bit over the last week or so, so we will be keeping a close eye on that. In terms of individual companies reporting, there's not a huge amount in the diary for this week ahead, but we do have results coming out from Home Depot and TJX. That's it from us. Have a great weekend, and we'll see you next Friday.